Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
It's another Financial Freedom Friday. I've got Ava Bouwkamp here with me, and we're going to uncover inflation. Bad for cash, good for real estate.
Hey Mavericks, this is Ava Bouwkamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
Welcome to the Passive Real Estate Investing with Mavericks podcast, where we provide you actionable steps to grow your passive income and become job optional. During today's episode, we're going to be tackling inflation. Bad for cash, good for real estate. For those of you who are new, I'm your host, Neil Timmins. I love passive income from real estate. Now, before I introduce you to Ava Bouwkamp, I want to make a request that at any point you like what you hear, give us a thumbs up. Be certain to subscribe to the show. Never miss a valuable episode. If you love what you hear, give us a written review. Plus, be sure to look at the description of this episode. We packed it with thousands of dollars in free resources. Well, it's another Financial Freedom Friday. I've got Ava Bouwkamp here with me. And Ava, we're going to be talking about inflation today.
Everyone's favorite hot topic at the moment, so we thought we better chime in on our 2 cents.
Yeah, there's no doubt about it. Well, maybe for the audience's sake, let's set this episode up for us and where we're going today as it relates to inflation.
Great. So this episode, I have to give credit to Neil Bawa. He totally inspired this episode in a recent presentation that he gave on inflation. And the information was so impactful that I thought, well, we have to spread the message and share it with our audience. So we're going to be talking about what inflation is, an example of inflation in action using money market accounts, and understanding how inflation relates to our high interest rate environment. And we're going to close it out with what that actually all means for passive investors. I think we all see a lot of scary headlines around there. And so we want to give you as the listener some power back so you can understand the terms that are being thrown around kind of willy-nilly, help give you some data, arm you with some teeth so that you can sift through all of that information with some clarity instead of having an emotional response to what we're being fed in the news.
Well, it's getting it can get scary real quick, and it's hard to know who to trust and what information to actually plug into, and then as a result, what action to take from an investment standpoint in order to place your bets. I don't really like that terminology, but in order to make educated decisions and place investments accordingly.
Yep, that's a great way to summarize it. So we're just going to start out with a pretty basic definition of what even is inflation. So technically speaking, inflation is the rate at which the general level of prices for goods and services rises over a specific period of time. So you can track inflation on a monthly, on an annual basis. There's all kinds of metrics, but it's really measuring how much that price goes up over a certain period of time. Another way to describe that same term is that inflation measures the decrease in your purchasing power of your money over, again, a certain period of time. So your money buys less goods and services today than it did a month or a year ago. So that is strictly speaking, what we're talking about when we talk about inflation. And when you hear headlines about inflation, it's commonly measured using two indices, the CPI, which is the Consumer Price Index, and PPI, Producer Price Index. And inflation, like we said in our headline, is bad for your bank account, but it's actually good for real estate. Mm-hmm. So Neil, why don't you talk about just a little bit, how does inflation actually benefit real estate owners?
Well, it benefits real estate owners in a couple of ways, and it largely benefits you when you borrow. Borrow, and my encouragement always is at an appropriate level, but it's simply this. If you were to borrow money, let's say you've borrowed money at 5%, right? Or maybe less. A lot of us locked in 15 and 30-year mortgages a couple of years ago at heck 3.5 or under that in terms of what it costs us. Well, the money today isn't worth the same as what it's worth 10 years from now, right? $1 is not the same. But when you have a fixed rate mortgage, we are simply paying them back with dollars that, don't look the same in terms of value some period of time from now. And so it benefits us because our dollars and our rents continue to increase and increase while we're paying fixed rate debt. And ultimately, property owners then, whether it's commercial properties or whether it's your individual house, you win over the long term in that scenario.
Yeah, the key there, I think, is over the long term.
Yep.
So obviously, a lot of people forget about this, but real estate, just like other segments of the market, is cyclical. Real estate goes up and down in different cycles, but over the long term, right, real estate historically goes up. So I think that's something that a lot of people lost sight of over the past couple of years when they scooped up properties at inflated values with cheap debt. But now that a lot of that debt is coming due, we're starting to see people be reminded that inflation works for the benefit of real estate, but you have to, like you said, use debt appropriately.
So I've touched on how it could be beneficial and is in real estate, especially when you focus on long term. Let's talk about banks and bank accounts. How in the world is it bad for those who conserve cash?
Yeah, great question. So I pulled some data. I said I wanted to give us data here in this episode. So I'm going to give off the annual inflation rates in the U.S. from 2018 to 2022. This comes from the Bureau of Labor Statistics. So in 2018, annual inflation in the U.S. was 2.4, 2019, 1.8, 2020, 1.2, 2021, 4.7, and 2022, we averaged 8% annual inflation rate in the U.S. So that's a scary number. Average inflation rate over the last 12 months, so June of 2022 through June of 2023, which was the last month they had numbers for yesterday, was about 7%. So it peaked at 9.1% June of last year and has been steadily going down. But over the last 12 months has averaged at about 7%. So if you have money sitting in a bank account, or a lot of people have been putting money in money market accounts that are making 4.5%, 5%, even with those numbers, which look really positive, if we're averaging 7% annual inflation, that 4.5% in your money market account really isn't doing you any favors other than making everyone feel better about losing their money.
We're going backwards in that scenario, 2.5% every year, right? And so it would be to make it, to just paint the yin and yang. To give you another example, it would be like being 2 years ago, roughly, where we were getting almost zero in the money market account, but inflation was 2.5%. We're in the same net position. We're still going backwards.
Yep. So inflation for June of this year is about 3%. So things are looking better from that perspective. But like you just mentioned, once inflation cools down and the Fed brings down their target, those money market accounts will move in step with that. And your 4.5% that you're getting right now, or 5%, is going to go back down. So if you have a lot of money sitting in a bank account, that's just something to consider. Do the math, look at the numbers, and realize that you might feel good about it, but that doesn't necessarily mean it's a positive and it's a win for you long term.
It's a wonderful strategy to have money on the sidelines, to be able to put it in a safe, secure place so that you can strike on something, but it requires having a plan in order to enter something else that can allow you to beat inflation so that you're actually moving towards accumulation and getting to passive income and creating wealth in your own life.
Yeah, and that's something Neil and I aren't your accountant. We're not your CPA. You should talk to someone who's a registered financial advisor, and they can help you strategize and plan out how you can use something like a money market account that's nice and liquid, but always be looking for that long-term perspective. So let's talk about moving on to the high interest rate environment that we're in. Like you mentioned, a lot of people locked in home loans at 2.5%, 3%. And now we're looking at home loans are now between 6 to 7%. What does this mean for real estate? How does this high interest rate environment impact real estate investors today?
Well, you're seeing it a couple different ways. Let's focus solely on commercial property. What's happening right now is there's a tremendous amount of cash on the sideline that continues to get deployed. And so we're seeing cap rates hold relatively tight compared to the lending rates, which is very interesting and reminiscent of kind of the 80s. As you went through 82 to about 87, somewhere in that range, where there was obviously a large tax bill that changed the whole tax landscape in 87. But because it's a safe haven, because it's a hard asset, that's largely the reason why you're seeing people deploy cash, their capital, into real estate, looking for a safe haven, trying to get out of the money markets, if counts, if you will, knowing that in an inflationary environment, cash is no good. You need to be in an environment with hard assets.
Yeah, absolutely. And like I mentioned previously, inflation peaked June of last year at about 9.1%. Just 12 months later, we're sitting around 3%. So we're on that downward slope, of inflation, but you still hear about a lot of distress in the market. There's a lot of concern, lots of headlines, but savvy investors and savvy passive investors know that the good time to buy is on that downward slope, which is where we're at right now. You can refinance when rates go back down eventually. And you see the people that bought lots of homes coming out of the 2008 financial crisis are probably sitting on a beach right now, which is not where we're at. We're here recording this podcast, but it's not a predatory statement, but intelligent investors can interpret that data and create opportunities out of the distress and the chaos that we're currently seeing and experiencing in the market, even when everyone else is kind of panicking. Well,
yeah, that, and I'll further that, inflation has gone from 9.1 to 3, and the Fed has still, in their most recent meeting, they still increased interest rates. And so the market as a whole, if you look at where the market is projecting, they're projecting that interest rates are going to fall in 2024, that the Fed is near their peak, and then it's a function of time. When inflation gets to their target at 2, that interest rates will start to come back down. And then we will find ourselves in a different environment. And those who bought quality real estate at sound fundamentals are going to be the benefactor, in my opinion, of really good real estate and the ability to change their loan structure and find themselves in a very nice cash flowing position.
Yeah, great. So we've talked about a lot of details. I want to boil this down for what this means for passive investors, give you guys some strategic and practical advice. So number one, I think Neil and I would both agree, is for investors out there, you get smart and get educated. You can't control what's going on. We're all bombarded with tons of headlines and news, but the only thing you can control is what's going on between your ears. So get as much knowledge as you can, follow the data, follow the numbers. Don't get taken advantage of by all of the crazy, hawkish, fear-instilling headlines that we see. The way that you can create a better financial future for yourself and for your family is to get smart around your money and around how you can use that best to fulfill and meet your financial goals.
Dad, I would say challenge what you know. Challenge what you know. A money market account making you 5%. Does it sound good? Maybe. Depends what the interest rate, or depends what inflation's doing. Would a money market at 15% sound good? Maybe. Depends what interest rates are doing. Depends where that inflation rate is. In a period of an inflationary environment, there is opportunities in hard assets. And that's why you see a whole bunch of people turning to hard assets such as gold, silver, crypto has come into play in the last handful of years. And then real estate. Real estate just happens to be our favorite, of course, because it's cash flowing. I can't eat gold. I can't eat the cash that gets produced from sound real estate can be converted into obviously our ability to spend it on anything we so choose, and that's why we love the asset class so much. But challenge what you know. No matter what's taking place in that money market, are we keeping up with inflation? That's the piece that we're up against each and every day. It's not some sort of competitive environment with somebody else or the next investment. It is, can we beat inflation?
Yeah. And, like Neil said, that's where we fit in. That's where, as an investor, it's a good time for you to look and find a trusted partner. If you're not going to go out and buy properties on your own, maybe you have a great W-2, maybe you are really good at something, maybe you're a doctor, a dentist, maybe you own your own business, finding a trusted syndicator or a general partner that you can invest with and diversify in your own backyard if they're syndicating deals in your backyard, or if you want to invest in deals that are taking place down in Texas, in Arizona, wherever you pick and choose, you can be in control of those decisions by finding a trusted partner who can give you access to those commercial deals, multifamily deals, industrial deals that you may not be able to find or acquire in your own backyard, but you can still take advantage of investing in a hard asset. So those are our takeaways for you. Get smart, get educated, challenge what you know, and that's what we have for you on this Financial Freedom Friday.
What a great conversation. See everybody next Friday. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.